what I'm hearing is like another vote for waiting to set up an S corp until you've covered all of your bases and figured out kind of your strategy and your goals with your money.
Yeah, yeah,
Which is kind of what I recommend anyway, because a lot of people get sucked into this, like, I almost want to call it a fad, but it's been around forever of just electing S corp status to save money on taxes. But the tax pros that are pushing this aren't looking at the whole entire picture, right? If they're not looking
yeah.
at the retirement plan and all of that in conjunction with the tax savings of the S corp, like it might not make sense. Hey, and welcome to the Ambitious Bookkeeper podcast. I'm Serena Shoup. I am a CPA and mom of three, and I'm running a virtual bookkeeping business mostly from my home. You're in the right place if you're a bookkeeper, accountant, or an accounting student, and you know that your purpose is bigger than sitting in a cubicle. If you're ready to learn some actionable tips and strategies to help you start and grow a bookkeeping or accounting business, I hope you stick around. Welcome back to the Ambitious Bookkeeper podcast. Today we have another guest on. His name is Matt. I almost messed that up because we just talked about that and I was going to call you Mike, but it's Matt Ruttenberg. He's here to chat with us about retirement planning, which is something that I feel like all of us bookkeepers can be better versed in. So I'm super glad you're here, and I'll let you introduce yourself with your background
Yeah,
and how you got
thanks.
here.
Thanks, Serena. Appreciate you having me on the podcast. Yeah, I've been in the business for 20 years. I'm a co-owner of Life Inc. Retirement Services, which is a basically a custom 401k slash retirement plan administration company, and which means we're the ones who design the plan. We create the documents, we do all the compliance, and act as fiduciary and all that things. So we build them from a custom level. Again, doing it for 20 years. I also own a online life insurance company agency for term life insurance called SureLI, and that's another secondary business that kind of flows together. Been doing this for a long time. Been doing it for a long time.
Awesome. Well, I personally am excited to talk to you and selfishly ask some questions
Go for it. Yeah.
about retirement planning. And before we hit record, I was saying it would be really cool to talk about advanced strategies for saving tax monies, which
Yeah.
is always something that is a hot topic, right? Everyone would love
Yep.
to save money in taxes. And it's like a double benefit when you can save money in taxes and put money away for the future. So I guess we could just start there. And yeah, give us your best tip on that.
Yeah. Yeah. On a high level point, a lot of times, we always ask two questions when the client comes in. What's your priority? Is it you or your employees, basically? And then how much do you want to save? And the first question is kind of aligns the design of it. Do we need to focus on the retention and recruitment of employees? Or do we go another path where that's kind of yes, it's nice, an ancillary piece. And the number one goal is to save taxes in the stockpile for your own retirement, right? Or both. A lot of times it's both. I want to take care of both.
Yeah.
And so in this instance, in this scenario, we're kind of talking about more of the stockpile for yourself and to save money on taxes. So we go through certain plan design strategies. So this is for high income folks, right? This is kind of a high income strategy scenario. And I want look at it as an upside down 3-tiered wedding cake. Okay, so you have this visual of the upside down, the smallest level is now on the bottom, middle is in the middle, and the largest is on the top. So the bottom layer and every layer above has to be designed a very certain way, special way, in order to maximize the layer above it. And when you do it that way, it's the most efficient and most streamlined model in order for you as the owner to give yourself the as many of the contributions as you can versus having to give too much to the employees. Now, everything in business is the net, right? Are you in the red? Are you in the black? And yes, if you have employees, you're going to have to give money to them on these qualified plans. Qualified plans are anything that the government, the IRS, is giving you tax breaks on, basically. So pre-tax, Roth, that's all considered qualified. And there's fairness rules that are involved in those. So no offense to business owners, but they don't really care about you. They're giving you the tax breaks. They care about the non-highly compensated employees. So anyone who earns under $155,000 and is not an owner or a relative of the owner. All those annual testing fairness rules that we talk about, it's all geared around them. So we have to give them something. And the idea is to let's give them the bare minimum if the overall goal is to stockpile for the owners.
So you did mention for the fairness rules, non-highly compensated is 155,
Mhm.
155,000 a year. Is that kind of your benchmark for a high earner as well? Or do you have a different number?
So I would say no on that because when you're looking at, let's say you're in the 150 realm, right? And a lot of this is dependent on how are you filing? Are you filing as an S corp? Or are you just doing LLC? Schedule C. So let's just say 150,000. Okay, let's just say that's your net revenue, right? And you're filing as an LLC. That's what you're bringing in. And how do we max out? How do we maximize that? And we're going to probably do. And let's assume we don't have. Do you want to assume we do have employees, or do you want no employees on this scenario?
Yeah, let's assume some employees on this one.
Okay, yeah. And the term highly compensated employees, since you brought that up too, is it's a for 2024, it's 155,000. 2023 is 150, and it's always retroactive to the previous year. So
Okay.
this year's highly compensated employees are from last year's calculations. Or a 5% owner is also, or more, is considered highly compensated, regardless of how much you pay yourself. And then like the kids and spouses are also considered highly compensated. So those are in one category, and then everyone else is in another category, is assuming they're eligible, full-time employees, which is 1,000 hours or more. Which technically, if you do the math, it's 20 hours a week. So
Okay.
whatever, anybody over 20 is eligible. Now, with employees, we're going to want to do a safe harbor because the safe harbor 401k is has it bypasses some of those fairness rules, the annual testing requirements. And the way the concept is the IRS says, okay, if you choose one of these pre-approved matching investing schedules, check, you pass these tests, and now you and your highly compensated employees are allowed to max out as an employee contribution, so which is that $23,000 that we all know and love, right? So that's 23,000 straight out of your paycheck, basically. Whether you are filing as a Schedule C or an S corp, 23,000 is considered an employee contribution. Okay. Now, above and beyond that, we're going to do profit sharing. And when you put those two buckets together, you're allowed to put in $69,000 as in 2024. Okay. Now, profit sharing isn't as easily calculated as the employee portion of that 23, because that difference of whatever that is, 45,000 or so, is you're not allowed to do more than 20. A rough When you're filing as a Schedule C, it's around 20% of your payroll. Okay. So if you're doing 150,000, 20% of 150,000, what is that? That's 20, 30,000, $35,000. So that is what you can stack on top of your $23,000 total for your own bucket, right? So we're
Okay.
looking at $58,000 or so. So you're not quite at that $69,000, but you're getting to that 58, and that's how you maximize you as an employee. Now, what you're going to do is how do we minimize the other employees, right? So you don't want to give everyone 20% of their pay, right? Or 20. They can put in whatever they want in
Right.
the employee bucket, right? Up to 23,000. But there's certain safe harbor options that we want to use, and it's called a non-elective 3%. Okay, so there's matching, where if an employee puts in 6%, you're going to give them 3.5 or 4 or 5, whatever. There's different vestings, there's different matching schedules. But the one that is the most efficient is called the non-elective 3%. And that goes to everybody who's eligible, including those who don't put money in. Okay. So if they're eligible, you're going to give it to them. So depending on the employee pool and the company makeup, it might not make sense. But the reason you do that is when you're looking at that 3-layered wedding cake, right? We're talking about the bottom layer is the safe harbor 3%. Now we want to get into the profit sharing. Now there's a 5% gateway that you have to give everybody as profit sharing. Even if you give yourself the majority of it, you have to give everybody 5. So when you use that non-elective, that 3% actually goes towards that 5. So you're still giving 5% to them no matter what, right? But if you did a match instead, so like a 4% match versus the 3%, you're going to stack the 4 on top of the 5, and now you got to give them 9.
Okay.
So efficiency, 5 is less than 9. Obviously, let's go with the 5. So that's a way to do that, maximizing and designing each layer to get the layer above it to be more efficient. And then there's another layer, there's multiple layers above that where you can get into cash balance plans. You can get into non-qualified retirement plans, or if you want to focus on only one person and not have to worry about all those fairness laws. And that's where you can get it well into the 6 digits. If you do a cash balance plan, which is a form of a defined benefit plan, pension, it's kind of like a casual version of a pension, if you will. There's a balance, and you can shut it down and you just roll it into the 401k. But if you have a client who is nearing 60 in their 60s, they're able to put in $300,000 pre-tax into a cash balance plan. That's where the real high level stuff. And then there's, you can add a non-qualified on top of that even, and they get substantial savings. And there's this working with business owners and entrepreneurs who have multiple businesses. There's this point where they get where the taxes kind of get out of control. And there's only so much you can do without having to give it more to your employees, or if they're really high level, surgeons sometimes that we work with, and they're creating these high level plans, but then they're still making a lot more. What do you do with the rest of it? That's when you get into the non-qualified plans, and it's called Section 162, where you can focus just on yourself instead of giving it to the lot of everyone else. So, yeah.
So when you were talking about the fairness rules, does that pretty much apply to setting up a 401k? And then the non-qualified plans are like a SEP or something?
No, so yeah, qualified versus non-qualified.
Yeah.
Qualified is anything with a tax break. So it'd be the 401k, profit sharing, cash, pensions, cash balance plan. Those are all considered qualified. And non-qualified, you don't get that upfront tax break on non-qualified, but there's multiple ways. I just did a seminar yesterday on this, and there's multiple ways to get the money out of the business in order to do that. You can either target key employees, like if you have a succession or a successor to your business that you want to make sure they're taken care of and you want to hold on to them. That's the only person you really, really want to take care of in that situation, where everyone else is getting the regular 401k, maybe profit sharing if that's wanted. But you want to focus on this one person, or you as the owner. You want to focus on you. You have to go with the non-qualified option and Section 162, and you can get into even deferred compensation, if you've heard of that terminology. And that's a really high level opportunity past that. It's like the opposite side of the spectrum of a cash balance plan. So you want to put in a lot, 6 digits into that. You can either focus on just you, or if you want to give it to everyone else. But generally speaking, it's pretty efficient when you do it the right way. It's not. There's multiple kinds of plan documents when you get into the 401k space. So a lot of the direct to consumers that you see online, the guidelines, the ADPs, even the payroll companies that offer them, Betterment, Human Interest, they're using prototype plan documents. And those are like plug and play, like write in your name here, write in your business name here, and here's your 401k. Not a lot of customization there. When you get into the custom plan documents or non-prototype plan documents, that's when you get really, really creative. And that's the kind of stuff that we do.
Okay. That's helpful to know. So can you explain so we talked about plans with employees. Can we go now switch gears and talk about plans without employees?
Yeah.
For our single owners over here.
Yeah, those are easy. Yeah, those are the easy ones. You don't have those fairness rules. The only thing you have to do so solo 401k is now what we're talking about. And a solo 401k, the only time you even need to file a 5500, which is the annual filing requirement for a 401k or profit sharing, you don't even have to do that until you hit $250,000 in that account. Prior to that, there's nothing. There's no filings whatsoever. In a group plan, it's day one, year one. You can have the $1.50 in there, and you still have to file a 5500. But it's the same concept, that 3-layered cake, right? And I call that like your retirement plan stack. You add a layer as you need a layer, as you need a layer, and you just keep building that and building that. And it's the same thing except you're using solo 401k. It's much easier to max that out because you don't have to worry about the other folks with how much you have to give them. The net, you're in the black 100% instead of in the netting down a little bit. So let's use this one, and let's say you're an S corp instead of doing LLC on this situation. When you're an S corp, obviously we have to give ourselves some sort of reasonable salary, right? And that's the biggest question: is what the heck is a reasonable salary? What's that definition? But let's just say it's 100,000, right? And you're bringing in 300,000 a year, and your reasonable salary is 100,000. Everything in the 401k qualified space, every calculation is based on your salary, not the distributions. Distributions are not considered earned income in this space. Like, kind of like if you're in retirement and you're taking withdrawals from your IRAs in retirement, that's not earned income. You're still paying income tax on it, but it's not earned income. In order to contribute into a qualified plan, you have to have earned income. And it's so instead of about a 20% calculation on your profit sharing, it's now 25. So the 23,000 as an employee of your own company, and then you're going to add 25% of the $100,000 salary you give yourself. So 25,000. Now we're at $48,000 is the max. Okay. So the S corp, yes, it saves you, the self-employment tax, the FICA tax, but at the same time, it hurts you on what you can contribute into the plan because you cannot count distributions in any of these calculations. So if you want more than the 48, then we have to go into one of these more advanced programs. And this happens a lot when someone there's multiple sources of income coming into the family, or you have multiple companies, or you have a day job and they're offering the 401k and yours is kind of like the side hustle. And how do we just stockpile as much into the 401k and the profit sharing while I live off of my salary at my day job? So these are all things that go into the deciding factors. And a consultation is super important. And yes, that you can do a lot of learning on your own and trying to really figure out what's available, but there's so many little nuances and loopholes and gray area. Sometimes just a phone call makes the most sense just to figure it out. And it gets really, really complicated, but this S corp is kind of difficult because sometimes it's like you're paying yourself $30,000 and everything else is.
So what I'm hearing is like another vote for waiting to set up an S corp until you've covered all of your bases and figured out kind of your strategy and your goals with your money.
Yeah.
Which is kind of what I recommend anyway, because a lot of people get sucked into this, like, I almost want to call it a fad, but it's been around forever, of just electing S corp status to save money on taxes. But the tax pros that are pushing this aren't looking at the whole entire picture, right? If they're not looking at the retirement plan and all of that in conjunction with the tax savings of the S corp, like, it might not make sense. So yeah. So what's the difference? So you said solo 401k, and I want it for any listeners that are kind of like a little newer to retirement lingo. Can you explain explain a solo 401k as opposed to like when you actually don't have that option anymore?
When you need to graduate, if you will, into the group plan. So 401k is a 401k is a 401k. It's all about how it's tested and how's the administration, how's the compliance around it. It's all the same tax code. So when you're solo and you have part-time employees that are under 1,000 hours a year, you can go that route. There is a rule there where if they're with you for 3 years, it's coming down to 2 next year, I think it is, when they change the laws on that. But if they're with you for 2 years and they're 500 to 1,000, they will then be eligible as well. Or your spouse, if it's just you and a spouse, right? That's still considered solo. You're okay doing that. But once you get that one W-2 employee, 1099s don't count. They're their own. They kind of run their own business, basically. Once you hit that W-2 that's 1,000 hours or more, you then have to start looking at the group plan. And even if it's one, it has to be a group plan. If they're not eligible this is really important. If they're not eligible, you can still do the solo, even if you do have a W-2 employee and they're not eligible. So if they're under the 1,000, you can still do the solo. If they're over the 1,000, you have to start thinking, how do I want to make them eligible for the plan? And the rules are, you can go as far out as a year on your eligibility. So they have to be with you for 1 year in order to allow them their own money, put their own money into the plan. So when you do it that route, you can say, okay, I hired this person in March. I can finish 2024 as a solo 401k and switch in 2025 when they're eligible. So that's a big strategy there. And beyond that, you can even do semi-annual enrollment periods. So you can do instant enrollment, you can do monthly, semi-annual, whatever you want. Semi-annual is as far as you can go on that, meaning January 1st and July 1st is when they're allowed into the plan during the year after they're eligible. So if you plan it right, let's say they're hired in the second half of the year in 2024, then you don't have to worry about, so let's say it's August. So a year from August is August, and then they would have to wait until January 1st of 2026 to be eligible. So then you have 2 more years of solo 401k. So there's a lot of strategy, and it's all dependent on how you answer that first question. Is it for you or is it for your employees? What's the goal here?
Gotcha. And then, so if you are on a solo 401k and you are hiring and building a team, that's something to think about talking with your plan administrator about changing to a group plan, right? And is that a difficult process?
No, the plan actually doesn't even change. The plan document, when we do the plan document, we try to look, we foresee that down the road. We kind of see what's the growth of the company, what it's going to look like. Can we go ahead and put something in the document that identifies that eligibility in the future? But at the same time, sometimes that just happens. Most of the time, it just happens. You don't know. You're like, oh gosh, I need someone tomorrow, and you hire
Yeah.
somebody, and you have to amend the document. Our company does not charge for any amendments because it's part of the natural flow of business. If you want to have growth in the business, I think we all want growth in our business, then you need to be able to make that change, and we don't want a fee to get in the way. So you have to do it that way. You have to do it that way, and you just do a quick amendment to the plan and move on.
Okay.
So talking ahead of time is really important because once they're hired, they're hired. So we have to adjust that and make the eligibility. It's better to know ahead of time, which we usually do. Anytime we do a solo 401k, we most often will say 1 year eligibility, 6-month enrollment, almost every single time, because we don't want it's you can amend a plan mid-year when it's an improvement to the employees, but if it's not, then you have to wait till January 1st to do all these
Okay.
different notices and things like that. So it's better to make it
Yeah.
push it out as
It's
far as
also a
possible.
good strategy if you're not sure if they're even going to reach the 1,000 hours, or like if
Mhm.
there's going to be turnover. You know what I mean?
Yeah, turnover is
So,
big. Turnover is
yeah.
a really big topic right now that has to do with your vesting schedule. And there's a lot of strategy around your vesting schedule, especially if you're not doing a safe harbor or you can't afford to do a safe harbor because the annual testing, if you've heard, or a lot of people have heard about, where you get a check back at the end of the year, especially employees will get a check or an owner will get a check because they failed their annual test, right? This is if you don't have a safe harbor, you have a traditional. And the reason you would want to go a traditional is because you want to mold the plan very specifically. So, like I said, safe harbor is turnkey options. A traditional is you can mold your vesting and matching schedules and to within limits to kind of however you want. But the rule on what the owners and highly compensated are allowed to do is they're only allowed to put, this is kind of a rough calculation, but it's 2% over what the non highly compensated are doing, even if it's zero. So if you have 10 employees, half of them are zero, half of them are 10% is what they're putting in their own money. That's an average of 5, and you're only allowed to put in 2% over that average. So, and if you're paying $100,000 salary on yourself, that's only $7,000 in your 401k out of the
Yeah.
23 that you're allowed to do. So what we will do there is we'll create a match that's really spread out as long as we can. So like 25% on 6 or something, because we want to get them to put in as much money as we can to push out your
Mm,
contributions. And then the vesting schedule is all about, it's really about protecting cash flow and protecting the
okay.
assets of the company. And you can push those out as far as 6 years on both your 401k and the profit sharing and the cash balance plan piece.
Okay. So when does it make sense to have, like, instead of a 401k, a SEP or something like that?
Yeah, great question. It's all about that second question, is how much do you want to save? And we're not a all things 401k shop by any stretch of the imagination. It's which one makes sense. So we, anything for business owners is really what our, is how we look at it. So if you're a solo, so let's say you're a solo entrepreneur, you have no employees, and you want to put in $6,000 a year, that's what your budget is, then just do an IRA. Do a Roth IRA. Don't even tie it to the business at all. Just do the IRA. It doesn't matter, because once you go into the business accounts, there's a little bit more headaches coming into play. But here's kind of a rule of thumb: if it says IRA at the end, administration, there is no administration costs. You don't need to hire the administrator. If it says 401k at the end, or profit sharing, or whatever, then you need an administration company to do the annual testing and the filings and things like that. So if you want to do 10,000, then you can say, okay, SEP, but that's all dependent on how much you're paying yourself, right? A SEP is basically a simplified version of profit sharing. That's all it is. It's the same exact limit, 69,000 for 401k and profit sharing, or all profit sharing is 69,000, and the SEP is 69,000. It's just the calculations. There's a lot of advanced profit sharing calculations that you can stack on top of 401k, where you can target people. When you go with the SEP IRA, then it's whatever you give yourself, you'd have to give to your employees. But the calculations are very simple. So it's 25% if you're an S corp, and around 20% if you're not. Same calculation. So if your $10,000 contribution goal that you want to do for that year calculates out within the SEP, do the SEP. Do a simple IRA. Do it. The simple IRA even works. You can do a simple IRA with no employees. It does not matter. So it's once you hit that, like, I want to put in 20,000, but you're kind of hindered because you are an S corp, and you're not able to put in, max out, and the calculations for 401k are all, whether it's solo or group, are way more favorable because of that employee contribution of 23,000 is 100% of your pay. That's a huge calculation boost, if you will, when you do the
Yeah.
401k. So if it's within the amount that you want to budget into contributions, go traditional, go simple IRA, go SEP. Once it gets above that, then you can graduate into it. And there's a lot more conversation around that too. But yeah, don't overdo it. You don't have to overdo it if you don't
Yeah.
need to.
So basically, the way the SEP works is you really only recommend it if you're able to contribute more than the maxing out your own IRA, right? So more than it's 6,500 now.
Yes.
So if you're willing and able to contribute more than 6,500 and you want to, a SEP might make sense. However, what you're saying is if you contribute, like, say I've already maxed out my personal IRA at 6,500, but the business had more income. I have cash left over and I want to contribute another $10,000. I would need a SEP for that. But does that mean I have to contribute $10,000 to my employees as well? Or
It has to be a very rare occurrence for that to work out, where the SEP makes sense if you have employees.
okay.
I would honestly probably say let's just do profit sharing plan. But the reason is, yeah, it's not 10,000. So if you give yourself, it's based on your salary. This is
However,
kind of,
if you're an LLC, you don't have a salary.
yeah, but it's based on what you pay them,
Okay.
right? So it's like there's a lot of people think you can't even do employee contributions if you're just an LLC, because you don't have a salary, but you can.
Okay. Is it
You
based on how
absolutely
much
can.
I take in draws then? Okay.
No,
Okay.
it's just based on your net.
Oh, the
That's all it
net
is. So
profit. Okay.
yeah, it's still coming out of the corporate account
Yeah.
on both. It's just tagged as employee contribution.
Okay.
So you can absolutely, even if, so that, I'm glad you brought that up, because that is a big misunderstanding out there, where if you're not paying yourself as an employee, meaning S corp, you can only do the employee or employer contributions, which is SEP or just profit sharing. That is not the case at all. You can do both. You can still
Okay.
do both. It just comes out of the same account, and it's just earmarked in the
Okay.
plan as employee versus employer.
If my net profit is $50,000, that's what they're saying. That's my salary amount, right? Whether I took it or
Yeah,
not.
exactly.
And
Exactly.
so that's the number that we're using for a calculation on the SEP. So then if I want to put $10,000 of my wage
Mm-hmm.
of the 50 grand, I don't know what percentage is that, like
So it's
10,
20%, right? Yeah. So
20%.
yeah, which is the max. That's the
Right.
maximum you're allowed to put in if you're an LLC and you're filing as a Schedule C.
So then I would
Um,
have to also
yeah,
contribute 20% of my team's salary, correct?
exactly. Whatever you're
Okay.
paying them. Yeah.
Gotcha.
So so when you go to that route, then like $10,000, right? That's the goal. You can either go all profit sharing instead of SEP, which takes administration, but there's different ways to do profit sharing. I would just keep it this. There's about 4 different kinds of calculations, and some of them you can even remove departments because I'm already giving them high commissions or things like that. It's called new comparability. It works out sometimes, sometimes it doesn't. But in that exact instance, if you had employees when you pay yourself 50, you want to put in 10, simple IRA definitely is the way to go because you can put up to what is that? I don't even know what the limit is these days. 16 or 15.5, I think it is, for simple IRAs now. As an employee of your own company, you can put it up to that amount. So you can actually do better with a simple IRA
And
than you
that
can
becomes a
with SEP.
deduction for the business as well.
Mm-hmm. Yeah,
Okay.
and then all you're doing is giving 3% to your of their, and you're giving them 3% instead of 20 because
Gotcha.
that's the match in as simple as 3 or 2. You can give a 2 non-elective contribution as well. So again, it's like every question is dependent on how you file and what your specific numbers look like, how your
Hmm.
employee makeup looks, and what the net is.
Yeah. Some stuff to think about.
Yeah, there's a
Sounds like I
lot.
need
There's
to
a
book
lot
a
to it.
consult.
There's a lot to it, and this is the biggest piece of advice I give to everybody out there is don't wait until the last minute to look into this because it is so vast. The retirement plan space is so vast. We teach financial planners this. We teach CPAs this. We teach bookkeepers all this. We teach everyone in the because it's this corner of the industry that is so complex that if you don't have a main focus on it, you're missing out. You're missing out. Yeah, the basics will check off. Yeah, I have a 401k, but there's so many little nuances that you can and can't do, and so much gray area that you can work around and make changes to. And sometimes it's one kind of creative plan design that we use, and I guess I'll just kind of leave it at this as a creative option is you can cut out highly compensated employees from a safe harbor and still pass your testing. So sometimes we'll say, okay, let's say there's 3 owners and 10 staff, but the owners they're like, they don't care about matching themselves. They just want to max out the 23,000. They don't care.
Hmm.
You can cut out your highly compensated in ownership from eligibility from a safe harbor. So the safe harbor, this is a great example of why the IRS does not care about the highly compensated employees. As long as you have the safe harbor for the for the non highly compensated, they're getting what they need to. The owners, even though they're not matching themselves, they can still max out the 23,000 because they don't care. As long as you're
Yeah.
giving the employees the safe harbor option, it does not matter. So, and you can cut out, or if all your sales staff gets paid really high commission, they're all over that highly compensated level. You do the same thing. So there's so many different nuances. It's not like one size fits all by any stretch of
Right.
imagination.
Yeah. Awesome. Okay. So since most of my listeners are bookkeepers, accountants, CPAs, if someone is like, oh, I need to connect with you for my
Yeah.
clients or for education, what are their options and what's the best way for somebody to reach out?
Yeah. So we have our website is lifeincrs.com, and you can also do 401k.expert, and it gets you right to the same site. It just forwards on to that. And for accountants and CPAs and bookkeepers, we have a partners page where you can go in there and just book a consult with me or somebody else that's available, or you can always email me at matt.ruttenberg@lifeincrs.com. Very long email address, but you can connect with me straight through the website as well at 401k.expert and keep your life a
Awesome.
little more simple.
And so how do you work with bookkeepers and accountants versus the business owners? Like, what's that
Yeah,
partnering look
it,
like?
it's all about open communication. We ask the client that we can have a conversation with the bookkeeper and the accountant, giving access to, third party access to folks. And we even offer referral fees for bookkeepers and just partners in general. We offer referral fees too. So that's kind of a way to connect with us or work with us. But the main thing is communication. We love talking to accountants and CPAs and other partners because it's it's all connected. We're just one cog in this whole thing. So a lot of times after the tax season's over, it's good to say, hey, my client has this much money that we need to get off the books. How to do that and how to get most of it to the owner. And it might be a different calculation for profit sharing this year than it is last year. So there's different way. Again, no plan amendment fees because that happens. That's the goal. Everybody wants to put more money into the plan. And then for solos, open communication. We are the busiest out of the year for solo 401ks the week before New Year's because everyone
Oh, because the
is
deadline
reaching
is
out, right?
actually the end of the year on that one. Yeah.
Yeah, and actually, I want to bring up something else. The deadline for your employee, it's what's your salary? You got to finalize your salary. Do you need to do It's okay to do special payroll runs at the end of the year to be able to do all these things, do these calculations, but doing it not the last week of the year, doing it maybe the last month of the year is best. December would be great to really start planning ahead on that. And as far as like solos, there's some special rules that just came out I want to mention really quick, especially right now. Let's talk about like the deadlines on some of these, right? Traditionally, the employee contribution is due, just slightly after the end of the year, right? That 23,000 is due just, not too far past the end of the year, but whatever that last payroll run rate is. As long as you're an LLC, that the first year you do a solo 401k, the very first year, the employee portion is not due until the time you file. Normally, it's 12/31. And
Okay.
then the employer contributions are pushed out all the way until you file, including extensions. So September, October, whatever that is,
Mm-hmm.
it can be pushed out that far. And same goes with the group 401ks.
Okay.
Yeah.
Awesome.
So if you have not filed your taxes yet and you're like, oh my gosh, I have this big tax bill, as of before you file, look into it and see what you can do.
Yeah, that's super helpful. So, I had one more question and now it's escaping me. Oh well.
You
Um,
can ask me later, no problem.
yeah, I probably will. But thank you so much for sharing all this valuable information. I encourage all you listeners to connect with Matt, connect your clients with him, especially if they are making a lot of money and they're trying to save on taxes and also set up their futures. It's a conversation you should be having with your clients for sure. And clients tend to ask us these questions anyway because they just assume anything money related that bookkeepers know. And I always say that we're like the first line of defense for a lot of things. It's great when the clients do ask us questions because then we can connect them with people like you and we don't have to know everything.
Right. Right.
So, yeah, I'm a huge proponent of creating connections with different finance aspects for your clients so that you have a point of contact. And Matt's a great one to have in your back pocket. Any other recommendations or mistakes you see made that you can maybe impart some wisdom on us?
Yeah, just it's that filing deadline. Don't rush to file. Sometimes if you have questions or you have a big tax bill, just don't rush to file. I see it all the time this time of year specifically, where they want to get it done and get it out of the way. I know not all accountants and CPAs want to see everyone just file an extension, file an extension, file an extension. But let's put it this way: when you file an extension, yes, you have to do that estimate and you pay your taxes around, but the deposit is still not due. You can implement and contribute all the way up until the day you file with the extension.
Okay.
You don't even have to implement anymore. That's just a Secure 2.0 rule. Is they push that all back. SEP was traditionally the only way to do that, the SEP IRA, but now all 401ks can be pushed all the way. There's so many loopholes. I'm telling you, there's loopholes. Just ask the questions, and we'll see if it works. If it doesn't, then no one's hurt.
Okay, I just remembered my question.
Go for it.
So, in a situation where there's multiple businesses and one business entity does not have employees and one does, are you still bound by if the owner is the sole owner of both entities? Are you
Yeah,
still
believe it
bound
or
by
not,
those rules?
this is a fun conversation that I like to have. So it's extremely complex.
Of course.
Yes. So double the episode. No, I'm just kidding. No, so you're getting, it's called controlled group rules. You're considered a controlled group. Okay. And this is sometimes not the greatest conversation we have with clients, because they're like, "What? I have to give this much money." But if you own 100% of two companies, one has employees, one does not, you're given whatever you give yourself. You can't bypass the employees and do a solo.
Right.
If that's kind of the idea, right? There's a couple rules there. One is a 50% rule. So if you have partners with the ones with employees, and you're maybe 30%, check, you're fine. You can do the solo. But if it's the other way around, then no, you can't bypass. And one rule is that's quite common, is the affiliated service group rule. And this is like doctors and attorneys do this a lot, where there'll be a partnership, there's partners involved. So let's just say it's 50-50 partnership, and they LLCs to their LLCs, and that's how they pay themselves, right? They can't go and open a solo 401k with profit sharing and cash balance plan and give everyone else, the employees, nothing. You have to have the exact, whatever you give yourself, you have to give them. You have to offer them the profit sharing. You have to offer them the cash balance plan. So there's a lot of rules. It's called controlled group, and it's a very, very, very black and white rule. And if you get audited, they're going to come get you, and you'd have to basically give all your employees what you owe them moving forward. So, and looking back.
Just making sure. I'm
No,
not doing that. But
that's a
it's like I
very,
do
very
own
common
two
question.
separate entities. So I was like, if I have this question, I'm sure someone else does, or they have a client with multiple entities and the client's like, I can just do a solo 401k in this business and not do anything over there to
It's part of
bring
our
awareness.
intake. Let's put it this way: it's part of our intake to make sure that we know all things business. And sometimes you want to have a control group, and this comes in with, like, say the two spouses own two separate companies, and we're able to commingle the plans together, so you don't have to double pay all the administration and all the filings and all this. It's just done under one umbrella, because you can connect. If your spouse has a managerial role in your company and does a lot, even though they're not on payroll, it's connected. It can be
Okay.
connected, and sometimes it allows you to include income from the other business that you wouldn't be able to before.
Yeah.
Higher contributions, higher calculations. So there's a lot more to that, but that's kind of like just ballpark answer for you.
Awesome. Okay, my last question
Yeah,
is, what is your fee structure like when you work with people? Do you do a flat fee? Are you more of a consultant, or is it like a commission structure? Can you
good
share that?
question. Yeah, good question. So there's three roles to every 401k plan. I'm just going to kind of start there. There's the administration, the compliance and the filings and all that. That's the administration. There's the investment fiduciary, and then there's the custodian / record keeper, kind of synonymous there. We're purely independent on the record keeper and custodian, because everyone has their own niche. Some Vanguard, Fidelity, not great to go to directly, but there's ones that you've never heard of, like July Services, Alaris. Then there's John Hancock. They all have their niche. Some like a lot of money, some like a lot of employees, and some of them like a lot of flow, like a lot of money going into the plan. So we handle sometimes just the administration side. And that third piece I didn't mention is that investment fiduciary. who is acting as the investment fiduciary on the plan, who's choosing the investment menu for your employees. And if it's not a financial advisor can sometimes plug in, we act as both the administrator and the investment fiduciary on majority of our clients. But if we partner with financial planners or something, then they will. The key is if the business is doing it, if the owner of the business is doing that, they are acting in the eyes of the ERISA and Department of Labor as the financial advisor for their employees. That's not a good idea to be your employee's advice. So it's good to off that liability to somebody, whether it's us or a financial advisor. So the administration side is flat fee based on participant count, and that's it. And then the investment fiduciary side is usually, depending on what we're doing with it, is usually a percentage of assets on that. And then the custodian, again, we are very neutral on that. And we are on the same side of the table as the client for that one.
So it just depends on where they want the things invested, and that's what you're saying.
Yeah, a lot of it goes into, what kind of investments do they like? Some have open architecture and some of them don't. Open architecture means we have the world of investments to choose from. And then we do self-directed. We do a lot of self-directed where the employees have a menu and the owner has a self-directed brokerage account. And we even put real estate inside of these things. We can literally do it. We have some that will allow cryptocurrency and some that don't. It depends. There's so many. We have dozens and dozens of them, and they all have their own fee structure. We narrow it down to 3 usually, but at the end of the day, the IRS wants you to benchmark your plan every 3 years or so for the custodian. And that's for your employees, so they're not paying high fees. So we do that automatically for our clients because we are neutral in that. And you can start with a lower cost provider because they love startup plans. And when you get more assets, then if you have $1 million in the plan for your company, that's a huge pricing tier breakpoint, and we move it and we negotiate with you and do all these things. So it's something that, again, if you have like your 401k with your payroll provider, like ADP or Paychex or something like that, they are who they offer themselves, right? They're not going to benchmark for you. So having that that shift away, integration is easy in 2024. Payroll integration is easy with 401ks in 2024. You don't have to have your 401k with your payroll provider to have that integration. It's technology is there to do it across the board. So you don't have to worry about that.
Okay. When you say neutral, does that mean like, say for instance, I have accounts already at Vanguard and Schwab. Does that mean like if I'm like, hey, I just want to see the plans that are available at Schwab so that all my stuff's in the same area?
Yeah. Great question. So actually some of the record keepers, look at it this way, custodian is like the basic level and record keeper is like the higher level of when they need to do a lot more, you're tracking more. You're tracking pre-tax and Roth and match and vesting schedules and all that. And that's not done on a street level of Vanguard, right? Or Schwab. So if you want to have all those over, again, you can do self-directed easily. Or some of the record keepers use Schwab as their custodian, as the custodian. Are they the best? No. Like Vanguard is such a hot custodian these days, right? Everyone loves Vanguard. If you go to the Vanguard and try to open up a 401k that's not solo is a whole different story. That's like DIY, do your own solo, it's fine. If you do a group 401k with Vanguard, it is going to be the most expensive plan on the market. And if you don't have, I think it's 4 million in the plan, they don't even do it. They white label another record keeper on the market that we use just directly, and they just answer the phone as Vanguard. And it's not actually with Vanguard. But if someone loves Vanguard, there's cheaper record keepers that have that open architecture method that we have absolutely designed an all Vanguard lineup inside another custodian.
Okay.
It's the same 6-to-1, half dozen the other. You don't have to go to Vanguard to get Vanguard.
Okay. Awesome. This is all really helpful information. I hope other listeners are nerding out as much as I am. Okay. So kind of just did part 2 of our little interview, but again, for anyone who wasn't listening, you can contact Matt, hook your clients up with him. We'll have links in the show notes and give him a call yourself, set up a meeting and figure out your own retirement stuff, set your goals and get things set up for 2024.
Absolutely. We just scratched the surface today. So there's so much to talk about, but reach out anytime.
Yeah. Thank you so much for your time.
Thank you so much.
Thank you to everyone who helps make this podcast possible. Content and interviews are produced by me, Serena Shu. Our intro and outro music is written and performed by my brother, Ian Gilliam. Editing is also by Ian using his awesome sound engineering skills along with Descript software. Hosting and publishing is by Buzzsprout, and you can check out the show notes for links to all of these amazing resources and resources mentioned in the episode.
Embrace ambition.